Welcome to Milestones, the ithought webinar, a roadmap from savings to wealth. This webinar is about how you are going to translate your savings into wealth. We are going to discuss issues which usually we don't pay enough attention to. And it is these factors and issues that we are going to discuss which actually play a great role in the translation of savings to wealth. Do people who earn a lot of money always create more wealth? By that logic, this person would never have become the richest man in the world with a salary of $1,000 per month. Evidently, you need to do a lot more than just earn large sums of money. Wealth evidently needs you to action a lot more than you think. Earning too much money by way of salary did not deter Buffett from becoming the richest man in the world. A smaller sum of money grew much faster than the earnings of others to leave him way ahead. But what happens to those who earn a lot of money? Would they definitely not end up being rich and wealthy? Then how would you explain the bankruptcy of these two icons? They obviously earned a lot of money and yet lost most of it. While they knew how to earn much more than Buffett, they obviously did not carry the right traits to growing their fortunes. To quote John Tyler, wealth can only be accumulated by the earnings of industry and the savings of frugality. The lack of frugality can destroy even the most stunning earnings. Their lives stand out as glaring examples of failure to translate stunning earnings into lasting wealth. Wealth creation is simply not about earning more. It is about how you manage what you earn. It is about how you position yourself with respect to money and how you deal with it in a decisive and disciplined way. What did Warren Buffett do right that these icons failed to do? In fact, most people fail to do. First, Warren started saving very early. He was disciplined with money from a very early age. He even earned small sums of money running a paper route and managed to grow that income by investing it smartly. This taught him that investing smartly was more important. Growing money was as important as saving it. He understood early on the rule that he practices to this day: never lose money. Now let us do a quick poll. Friends, what percentage of your earnings are you saving? You have a few options and I request you to click any of those options. What percentage of your earnings are you saving? That's the first question. And what do you think is the ideal savings percentage? We will have more of you to poll. I request you to quickly poll so that we could move on to the rest of the presentation. What percentage of your earnings are you saving? And what do you think is the ideal savings percentage? We still have quite a few to poll. I request you to quickly poll so that we could move on with the presentation. Have you finished polling? Have all of you polled? I still see that some members have not polled yet. So if you finish polling, we'll move on with the presentation. The two questions: what percentage of your earnings are you saving? And what do you think is the ideal savings percentage? We're getting your votes in. We still have a few of you are yet to vote. We have four categories: less than 10%, 10 to 25%, 25 to 50%, and greater than 50%. You would have to indicate what is your percentage and what you think is the ideal savings rate. We end up polling here, and we find that quite a few of you think that 10 to 25% is your percentage of saving, and 23% of you are there. But quite a few of you think that that is the ideal savings rate, in fact, the same percentage. And quite a few of you think, more people think that it should be greater than 50%. Now let's go back to the presentation. So how can we accumulate what a great investor like Warren did in our own way? We should practice a few basic things we all know and yet fail to follow. Money should be saved in significant sums every month with regularity. What we save should be invested smartly and sensibly. Remember, beating inflation is as important as saving significantly. Merely saving a lot of money and keeping it in your bank won't create great results. To achieve out of the ordinary results, you need to ensure that your savings are invested for long durations of time. Time is as important an investment input as money. Now we go to the next poll, and this poll is on inflation. We have two questions, and I would request you to participate in the poll quickly so that we can move swiftly back to the presentation. What do you think is the inflation rate in India? What do you think is the inflation rate in India? And the second question, how much do you think is a reasonable return to beat Indian inflation? I request those of you who are not able to quickly poll. Quite a few are already polled. 53% of you think that the inflation rate in India is between 7 and 10%, and 46% think that you need to earn more than 10% to beat inflation. 23% of you think that 8 to 10% is what you need to beat inflation. Now let us see more about this subject. Back to the presentation. India is a country with a relatively high inflation rate. You can have a look at these two graphs. Everything tends to become more expensive here. Inflation can kill one's purchasing power and make his money lose value much faster in India. If your money should not lose value and you should be able to retain your purchasing power, you need to earn at least 9% per annum post-tax on your savings. So, are your investments really beating inflation? Beating inflation is not a choice, it is an absolute necessity. So one needs to invest smartly and sensibly to beat inflation. Are your investments really beating inflation? Most Indians stick to a few investment avenues in their efforts to beat inflation. Let us now look at them in their sequence of popularity. Before we do that, let us do another quick poll on the various investment avenues. I request you to quickly poll so that we could move swiftly back into the presentation. This poll is about which asset class you think has given the lowest return in the past 10 years. Please click which is the asset class that has given the lowest return in the past 10 years. The second question is which asset class do you think has given the highest return in the past 10 years? This is a very interesting poll because you will find the answers quite interesting because it has been a race to both the top and the bottom. I request you to quickly poll so that we could move on to the presentation. There's still a lot of you who haven't polled. I request you to poll so that we could close the poll immediately once you poll. Okay, that brings us to the end of voting. 68% of you think that fixed deposits have given the lowest rate of return in the past 10 years, while 43% of you think that equity has given the highest return in the past 10 years. 31% think that real estate has given the highest return in the past 10 years, while 18% of you think that gold has given the highest return. Now, let us move on to the next part of the presentation and you will know where we stand on the returns in the past 10 years. Fixed deposits is the first and most popular investment avenue that we have. Look at this graph and you will know what fixed deposits do to you in the present. The fixed deposit or FD is the most popular investment choice, yet it almost always fails to beat inflation. Look at this table. You will clearly see that the post-tax returns from an FD fail to beat inflation. So if you are relying only on an FD to invest all your savings, you will find that you are steadily losing purchasing power. Every passing year will make you poorer. Your lifestyle will simply have to keep accepting less and less of creature comforts because your savings can't buy them. Real estate. Real estate is the next hot favorite. Indians have a great degree of comfort investing in real estate, and real estate has rarely failed to deliver for investors. The past decade has seen real estate as the best asset class. This is a graph that I am giving you for a populous locality in South Chennai, and you will see that the 10-year returns are 20% compounded. We have had a sustained phase of rising real estate prices. No other asset class has delivered like real estate in the last 10 years. But we all know that hindsight is an unreliable guide to making investment decisions, especially when the past graph looks too good to be true. A prolonged phase when prices remain flat at best seems likely. If the prices do fall, then things could get worse. In either case, the past performance should be used as a cautionary. Real estate investments should not be aggressively pursued now given the serious risks. Investment in real estate needs to be forward looking and the going could only get tougher from here. The next one is gold. Gold is next only to FD and real estate as the preferred investment option. And post the subprime crisis in the US, gold has had a dream run. And despite the prices correcting sharply, gold still has done very well. The 10-year returns from 2004 tell you the complete story. But the subprime crisis and QE in the US will soon become history as America changes its monetary policy framework. So gold is bound to lose some of its charm and a bit of its price sheen too. You will note that gold prices have already fallen from the dollar peak of 1900 it made in 2011-12. Clearly, gold prices have fallen and could go even lower as money shifts back to the dollar. Past returns should not be used as a lead indicator for investing in gold. A more subdued and consistent approach is needed towards gold investing. Insurance is increasingly viewed as investment. Just look at this chart and you will understand how a term plan is probably superior than an endowment plan. Indian investors increasingly fancy insurance schemes that give money back to us in our own lifetime. The pure term policy is not as fancied, though it remains the simplest way to insure oneself. Investors seem to prefer mixing insurance and investment. There lies the problem. Look at this illustration. Here, we will explain to you the benefit of keeping insurance and investment separate. If you choose to buy a term policy for 10 lakhs and avoid taking on an endowment, a lot of money will be available for you to invest. If you decide to invest that balance amount in a public provident fund, also known as PPF, you will find the benefits are much more. Look at this table and you will understand. At the end of a period, you will have 38 lakhs of rupees, while a 25-year endowment will leave you only with 24.5 lakhs. Not to mention, the money given to you by the PPF will be tax-free in your hands. Importantly, you remain insured as per your need. You still remain insured for 25 years for that sum. Mixing insurance and investment is best avoided. Now let's move on to equity. Equity is a difficult asset class for the Indian investor. The returns over the past decade stand at 16%. While equity has beaten inflation significantly over the past decade, investors have definitely failed to capitalize on it. The investment approach of Indians towards equity is distinctly flawed. Capital is deployed irregularly and gets lumped up when equity prices are very expensive. When equity prices are cheap, few investors venture to invest. Importantly, when they rise from levels when they are neither cheap nor costly, investors hurry to exit them. They don't stay long enough and invest it. Investors must learn to invest aggressively when equity is selling cheap. They must also learn to remain invested till they become expensive. And exits must be aggressively pursued when equity is expensive. Back to the question of inflation. That brings us to our mission. Beating inflation is not a choice. Savings need to grow faster than inflation. How you invest will decide the outcome. Smart investing will raise your purchasing power and secure your financial future. But one must remember to take on risk in a sensible way. Your risk should not become a bigger threat than inflation. How can one handle investments in a measured manner and yet beat inflation without raising the risks level beyond his risk appetite? Remember, your risk appetite should match the risk that you are taking on to achieve your financial goals. Only a method will help you do that. We call it the I thought way. The essence of the I thought way is given here. With 10 distinct principles, we ensure that risk is managed dynamically, investing is based on opportunity, savings are grown consistently, capital is allocated smartly, and now let us understand what this method is all about. The roadmap to wealth, the roadmap from savings to wealth is all about method. The first thing about method is that it should help you do things differently from how others do it. Most investment failure has one common feature. You did what everybody else did. In other words, you were a copycat. And you failed with the herd. The one thing you must ensure you do is to never invest in a herd or with the herd. So how do you avoid being part of a herd? It is easier said than done. To be out and far away from the herd, you must cultivate independent thinking. Independent thinking should help you have your own mind. This mindset should help you go against the herd, to be a contrarian, to stand against the majority and to beat the majority again and again. Play contrarian. The most common folly of investors is to save randomly. Most people think being frugal is enough to save, but intent needs to be converted to a plan. If you are frugal 80% of the time and 20% of the time you spend all the money you have, that frugality is not going to help. So your intent needs to be converted to a plan that ensures you set and achieve goals. Saving to a plan helps you do two things: to set saving goals and to achieve them. Many of us are hard savers. We manage to save very well, but we invest our savings rather randomly or in some cases rather poorly. It is important to invest to a plan. The savings plan and the investment plan should be aligned to each other. When we align the two plans, we are aligned for growth. The one thing that most investors fail to do is to review their investments. Many investors don't have a clear idea of where their monies are invested. Investments are often scattered across asset classes. The allocation of monies is not clearly understood. The situation needs to be corrected. A periodic review helps you to streamline your investing. The approach to review needs to be holistic. A regular review helps you to keep you on track and to achieve your goals. When does the herd rush to buy an asset class? The herd mentality prevails mostly when an asset class is overheated. When the prices are peaking, investors rush to buy the asset class. But a contrarian investor would look to sell an overheated asset. When an asset class is overheated, it's often the time to sell. Such selling helps you to create precious liquidity that can be used to buy undervalued assets later. How one invests in an asset class is very important. Now, when an asset class peaks and starts to cool off, that is when most people rush to invest. Most real estate investing happens in that rush. Over a weekend, investors make big decisions in haste. Rushing to invest is very risky. Many investors rush in when an overheated asset class starts to fall. More people make losses buying a falling asset. Remember, never catch a falling knife. Another often repeated mistake is that since you do not review, you don't know the composition of your wealth. This leads to your owning too much of an asset class. For example, you know many people who own more than one house or more than two probably, or many houses and a lot of plots. Don't put all eggs in one basket. Diversification is very important, and in that sense, you must avoid owning too much of any one asset class. Most investors mix up insurance and investment. The smarter ones do their insurance through term. Investments are best done separately. But investors mostly buy too much insurance and that too through endowment. By buying too much insurance, your returns are bound to drop. Please remember the illustration that I showed you earlier. Insurance must just be adequate and through low cost term policies. Liquidity is a very important investment requisite. Keeping some money liquid gives you a lot of flexibility. This flexibility ensures that you are in a state of readiness to invest. When opportunity presents itself before you, you are ready. Liquidity helps you reach that state of readiness and to stay in it. Adequate liquidity is advised to be maintained. The last point that I want to emphasize is on the power of starting early. Start saving for your retirement earlier if you don't want to spend your sunset years in penury. The difference between somebody who starts in their 20s or even in their 30s and somebody who is a late starter is distinct, and this graph shows you the difference. An early starter needs to save much less than a late starter, and he is able to compound his money much better than the late starter. So it's very important to start early. If you haven't started early, and let's say that you are in your middle years, you can still scale up much faster in the early years since you begin, so that at least a more amount of capital is left for longer durations of time to compound. That brings us to the end of this presentation, Milestones, and it's time for Q&A. Remember, what we have tried to emphasize is that wealth creation is a journey where you cross several milestones to reach your destinations. These milestones can be reached within reasonable time in a manner in which you can achieve your goals only if you have a very strong method. And this method should be practiced consistently across asset classes